Hi, everyone. Thanks for joining us tonight. So this is our Q1 2021 Market Outlook webinar. So basically, we're going to talk about what happened in 2020, just a quick market snapshot, and we're going to talk about what does the future sort of hold for us. So if 2020 was an year of crisis, we hope 2021 and beyond will be the recovery. Right. So in terms of what are the things that are top on mind on investors, number one, vaccine rollout. So vaccines have been starting to take effect, and a lot of companies are coming up with various levels of efficacy, and productions and rollouts have started, which brings us to the question that what would be the timeline for herd immunity and in general bulk of the population to get vaccinated. That should also sort of help in terms of boosting the growth. And, in general, there has been a lot of policy stimulus, both on the fiscal and monetary standpoint. So we'll continue to look at, how the path to economic recovery looks like. Going beyond using these two as a, sort of backdrop, how do you see 2021 and beyond, right? So that's a thing that is top on mind for everyone, and everyone wants to position themselves to take advantage of how the global markets are positioned for the future. So I guess the next question, of course, is how do you develop an investment strategy that takes into account all of these considerations and builds you a robust way to sort of grow your wealth? Now, in terms of agenda tonight, we will cover number one, the market snapshot for 2020, the path to economic recovery, the 2021 outlook, as I said earlier, the investment strategy for going forward. And then we will quickly wrap it up with a little bit of an introduction to Syfe and how do you get started and Q&A related to that. Even through the webinar, please feel free to post any questions that you might have. And Hayden is there with me, so he will keep collating those. And as and when, there are mid breaks, he will pose those questions to me, and we hopefully hope to answer as many of your questions as possible. All right. So I think quickly taking a look at market snapshot, I think even before going that, I think, it is important to highlight how, severe the pandemic was for 2020. And it was one of the most sort of catastrophic economic, downturns that we have observed since, I think, the Great Depression. The COVID sort of situation led to a lot of deaths, like more than 1 million people died actually due to the virus, and also led to a lot of disruptions across the world in terms of lockdowns and, governments having to take extreme measures to build, a way to sort of guard the community against spread of this virus. And it's only now that, we've got some ray of hope coming in with vaccine rollouts, and in general, governments around the world have been able to, sort of design ways to, get people to work and live with the virus as well. Now, looking at equity markets, similar to, the global contraction that happened, by the end of the year, though, a lot of recovery also took place. But I think that just, sort of glosses over the fact that essentially it was a very, very volatile period. And if you look at the chart on the right first, what you will observe is basically a 34+% correction that happened over just a few weeks, right? So February through March, from peak to trough, the S&P 500 corrected by 34%. It is like one of the worst drawdowns and that short a time frame. But what was even more surprising was the kind of bounce back that we observed post, government interventions. And I think this time it was really, the governments and the central banks and everyone sort of rallied together and made sure that they were, preemptively taking steps to sort of make sure that overall the economy doesn't suffer, and where there are, gaps and where there are, demand sort of losses, they quickly came in and filled up those gaps per se. So essentially what you saw is a huge rally coming to the end of 2020. And if you then look at all the different equity markets across the world, of course, the US market led most of the returns. So it was up 18+%. But even if you look at emerging markets, which was up 18.7%, and more selectively, if you look at China, which was like a bright spot, because they controlled the pandemic. Like, they went into the pandemic much earlier and they controlled it with much effective steps. And what that meant was overall the recovery was, a little bit more positive too. And if you look at from a equity market returns, that also panned out there, where China basically grew at like close to 30%. Now, again, from a laggard standpoint, the developed markets, European markets, and the broad level, ex-US markets didn't give that great returns comparatively, relatively. But overall, if you see, 2020 ended up into a more positive note, especially for investors who remained invested, did not panic, and they had fairly diversified portfolios. One more thing just to highlight here is the fact that there has just been a dominance of the US markets when it comes to long-term returns. And if you look at the 15-year returns of all the different markets here, it is really the US that stands out in USD terms. I mean, of course, there are some markets like China which did well, but that must be in local currency terms. But when you look at USD terms, the US market sort of had a predominance in terms of returns versus a lot of other markets. Now, one more thing to highlight, let's look at the same data in terms of asset classes instead of just geography. What was observed was, I think, if you look at the last, say, 10 years odd, there has been a reversal of sorts where more of growth stocks, large cap stocks have done fairly well. And what you saw in 2020 was on similar lines, but a certain amount of trend reversal is starting to happen that you're seeing right now, with small caps starting to make up. And if you look at year-to-date returns for, if you look at the right-hand side, this column, year-to-date, you're seeing some sort of trend reversals where small cap and emerging market equities and even commodities to a certain extent have started to dominate the returns for this year. And that could be a trend that can continue going forward, given the high valuations that you're observing for the global markets. So people are looking at relative valuation and looking at where there is value. Also, a point to note is, while this chart, I think, is a little bit confusing, what it depicts is that no one asset class has remained at the top in terms of returns throughout. And what that means is, if you build a more diversified, globally diversified and across asset class portfolios, those kind of portfolios have remained stable throughout the years, right? So this is something, again, that we try to educate a lot of our clients, that essentially you can have certain views and you can have certain asset classes that do really well in certain years, but it is also possible that they don't do well in certain years. So it's very important to have a diversified portfolio to really make sure that overall your returns are much more stable and steady. Now, coming to the path of economic recovery, I think if you look at, again, going back to 2020, the whole pandemic sort of began with China locking down the country, and initially the pandemic looked like it was just a China problem, but soon it spread across the world. And what that meant was, like, extreme measures needed to be taken. China, I think, to that extent, did much better, because they controlled the pandemic with a little bit more extreme measures, but that really resulted in containment of the virus much earlier. And to the extent that their economy recovered much faster than a lot of other economies, which sort of suffered the brunt of the virus, and the recovery timeline was a little bit elongated as well. So if you look at the chart on the left, it basically shows the red line, which is China, going down in terms of economic activity, but then recovering quite fast, versus the yellow and blue lines, which is basically advanced economies as well as emerging markets. The virus effect taking place a little bit later, closer to Q2, and then they starting to recover as well. But I think what is also more important to see is the dotted lines, which was like, the pre-COVID, growth rates that were expected for all of these economies. And what you see is roughly, again, China sort of getting back to the pre-COVID recovery levels, versus the other economies are still, pretty far away from the, their respective dotted lines in terms of where they should have been if the COVID never happened. Similarly, I think, important to just highlight that we are in a much better situation now versus what happened in 2020, and that just is depicted by virtue of how is the industrial production data, what is the manufacturing PMI, and these are data points that basically measure whether economic activity is expanding or contracting. So PMI, for example, basically tells you that essentially is there a contraction in terms of manufacturing activity, or is there an expansion? So as everyone can see, like in 2020, there was a huge plunge in terms of all of these activities, and then slowly everything recovered to the extent that now everything is getting sort of positive. So I think going forward, what will be important is the speed of the recovery is more of a question. I think, as I said earlier, we have learned how to live with the virus, and there are mechanics now in place where we are able to cope with it better. And alongside all the fiscal and monetary stimulus programs that the governments are running, I think overall we are in a much better situation. But for us to really come out of it full-fledged, the other thing to look at would be how do we contain the virus? Now, essentially, I think this is a little bit of a technical chart, but let me try to explain what this basically depicts. On the left-hand side, the chart that you see, there are x-axis and y-axis. The y-axis is basically talks about the efficacy of the vaccine that are coming onto the markets. So most of the vaccines, at least the ones that have been fairly well they have been tested fairly well, and they have been proven to be effective quite well. The efficacy, or the way to understand efficacy, is basically how effective they are, is close to 90+%. So essentially, the efficacy rate is measured on the y-axis, versus on the x-axis, what is measured is how much of the percentage population is covered through the vaccine. And what this particular graph is trying to depict is that the intersection between the coverage that you need versus the efficacy for us to achieve herd immunity. And essentially what that this graph is trying to then come up with is what is the percentage population that needs to be covered by the vaccine, so as to make sure that the overall population is sort of immune, right? And this also takes into account that there is a certain amount of population that has already gotten exposed to the virus, and that varies between 5 to 20%. So that, combined with the efficacy of the vaccine, how much of the population do you need to vaccinate in order to achieve herd immunity? And that varies between 50 to 60%. So if you get 50 to 60% of the population vaccinated, that will ensure that we reach that herd immunity, where further spread of the virus will be severely contained. Now, of course, this is the ideal case scenario, but more recently we have also heard that there are more infectious variants of the virus, and they're much more transmissible. And what that means is, if you look at the chart on the right, if the virus strain, the new variants of the virus is 40% more transmissible, then essentially instead of covering 60% of the population, you need to cover almost 70, 80% of the population to make sure that there is herd immunity, right? So good news is vaccinations are there, vaccines have been rolled out, the efficacy is good, but the fact that there are more infectious variants, what that means is if these infectious variants are more transmissible, we need to produce these vaccines in much bigger quantities. So capacity and all of those issues need to be managed such that we can reach the herd immunity, and we'll need to cover more of the population to be able to achieve that. And what that essentially means is, in terms of reaching herd immunity, if you thought if the previous estimate without these more transmissible sort of virus variants was, say, Q3, Q4 of this year, it just reaches more like 2022, where you sort of see the actual herd immunity come in, right? So essentially just delays the whole process of when we can reach this herd immunity, and at a state where everything can be opened up. Now, I think it is also important to highlight that alongside thing that is sort of on the virus front in terms of what we are doing, and what the pathway is for the containment of the virus and reaching herd immunity, it is very important to also highlight the fact that all the central banks and the governments have taken some extreme measures to make sure that while we live with the virus, the economy is sort of, well functioned, and there is no liquidity crunch. There is no, problems in terms of, people who are losing their jobs. They have sufficient ways and means to sort of, keep going about doing their things without being too much affected in terms of, loss of income and other things. So what that has really led to is a huge increase in terms of the Fed Reserve's balance sheet, to the extent that almost like the balance sheet increased by $3 trillion in 2020. And if you think about that extent of monetary and policy stimulus that went in, that $3 trillion is essentially more than QE, Q2, QE1, QE2, and QE3, which was like done post the financial crisis. It's more than the combined stimulus that was put in during the, post the financial crisis up to 2014. So it just goes to show you how aggressive the, central banks have been to make sure that, there is no liquidity crunch. And to the extent that now, with elections sort of getting over and Biden administration coming in, and they potentially also having control of the Senate, the policy stimulus programs might just continue. And, what that means is this balance sheet can, balloon further to almost like $10 trillion by the end of 2021. Now, of course, one question that everyone then has in mind is, if that is going to happen, what effect does that have in terms of inflation? Because if there is so much money that is getting printed, then will it really affect, inflation? And then would it result in other, problems with the economy as well, in terms of rising interest rate, and then, that having sort of cascading effects into the equity markets and beyond, right? Now, if you look at the inflation chart on the right, what you will observe is inflation has been rising up modestly. So, again, it dropped close to 1% in 2020. And since then, it's been rising a little bit, quite modestly, but not yet reached to the Fed target rate, which is between 2 and 2.5%. So the idea is like, overall, the inflation numbers don't look that alarming. And also, I think there are various factors at play when it comes to inflation, because normally it is assumed that if there is so much, money printing that is happening, it should naturally lead to more inflation. But I think there are more, elements and more factors in play, which is the reason why inflation is not yet sort of, peaked up in terms of, values going beyond the range that the Fed would like, including the fact that, inflation, the relationship between money printing and actual, consumer spending has weakened quite a bit. Because if you think about it, the government is sort of coming up with these fiscal policies, and on the other side, the Fed is just, buying up all these, government bonds. So in a way, it is going from one pocket to the other, rather than actually trickling down into the, actual economy in terms of banks lending those money out and resulting in, more money supply per se. So it's a little bit more technical, but I think the important thing to highlight is that, coupled with, the demand side of things, have still not come back. And what that means is essentially, for the foreseeable future, or at least for the next, couple of years, I don't see inflation rising by a huge amount. There might be a modest increase in inflation, but that's, I think, consistent with the fact that there is growth happening simultaneously. Now, looking at the US dollar, again, I think this is also something that investors are wary about, because given the policy programs that have been run, US dollar naturally has a more weakening trend going forward. And but I think important thing to highlight for US dollar is that, while the US dollar might continue to depreciate in the near term, it doesn't mean that US dollar will lose its status of being a reserve currency anytime soon. US dollar tends to sort of go in cycles. So if you look at, this data going back to, 1980s, there are periods where US dollar sort of appreciates quite a bit, followed by a period of, contraction. So it is, cycles that the US dollar operates in. And what that means is this could be a cycle of, modest sort of weakening of the US dollar going forward, and it can last for a few years as well. What that essentially means is that investors should be wary about it, but at the same time, they need to take measures in terms of diversifying their investments outside of US as well. Having said that, I think US and US equities will remain supported, but I think it is also important to have those elements of hedges built into your portfolio where you have outside US exposures, which helps you sort of mitigate some of these currency risks as well. Now, coming into 2021, I think maybe I'll take a quick break before I go into this. So, Hayden, any questions so far?
Right, Ritesh. So I think one of the more popular questions we have now is that as we're looking at the market prices now, they are at higher prices compared to pre-COVID levels. And with the increase in money supply, the stimulus packages that's been injected in the market, are we actually in a bubble now? What are we looking in terms of next few quarters? Will this bubble burst? And in that sense, for the ETFs, are they still a good kind of investment that we can invest this year?
Right. No, that's a great question, and essentially, I think that's what we will cover in the outlook section of our webinar today. So, but I think that is a question that is on top of mind for everyone in terms of valuations. They do look stretched, but nowhere close to the kind of bubble that we saw during the tech crisis in 2000s, right? Where the valuations and the PE ratios and all just shot up to extreme levels. I don't think we are seeing those kind of things yet. But in fact, I think most of the markets in terms of where they are and in terms of valuations, while overall the PE ratios and the valuations do look a little bit stretched, but overall that is sort of corroborated by higher earnings potential that we are seeing for these individual markets as well. So let us cover some of these as we move along. I think it'll become more and more clearer. Now, before going into that, it's very important to also highlight, how the world economy is looking from a look forward standpoint. If you look at 2020, the global economy contracted by 3.5%. Now, looking forward, 2021, the IMF recently revised its outlook for the global markets, and they revised it upwards. So essentially, 5.5% is the revised GDP growth number for the whole world for 2021, and that is basically on the back of a 3.5% contraction. So you're seeing a bigger sort of jump because of coming from a lower base as well. But I think going forward, like 2022 and beyond, it should then normalize to more sort of long-term numbers per se. Similarly, if you look at individual countries, I think US, for example, contracted by 3.4% last year. To the extent that actually 3.4% is the whole year GDP number. But if you individually looked at the quarters themselves, in Q2 the US GDP I think contracted by more than 30%, and then it was sort of a V-shaped recovery where it expanded by more than 30% in Q3, and to the extent that in Q4 then the normalization became much more sort of similar to closer to historical levels, to the extent now that if you look at going forward, again, from a US standpoint as well, for 2021, it looks a little bit more promising with a 5.1% growth, which is, again, more than the normal kind of growths that we see for a developed economy like the United States. And that's why if you look beyond 2021 and 2022, you see that the growth normalizing to 2.5%. Coming to Eurozone, again, the contraction was even more severe, and that also sort of reflected in how the markets and all performed for Euro area and other developed markets. And I think, again, some of the countries within the Euro area, they bore the brunt of the virus a little too hard. And to the extent that the economy contracted by 7.2%, and again, coming into the recovery, they are going to be expanding at 4.2% projected, and then normalizing to 3% from 2022. I think the two bright spots that you see at the bottom is more, relatable in terms of how there is a genuine shift that is happening where economic expansions are led by more Asian and emerging market economies. And if you look at China, for example, it was the only major market which showed an economic expansion in 2020 with 2.3% growth, much lower than its historical growth numbers, but it was still a growth that China could observe. Coming into 2021, again, a strong number of 8.1% growth, and then normalizing back to like 5.5%, 6% going forward. And similarly, India, if you see big contraction of 8%, but then a big expansion that you're seeing for 2021 and beyond. Now, coming to the equity markets, I think this is where, most of the people had that question that are the valuations stretched? Like, what do you think going forward, how the equity market will look like? I think, my overall sense is that, the current markets, yes, the valuations do look stretched. If you look at it from a PE ratio standpoint, we are somewhere close to 21, 22 PE, which is more than one standard deviation above the historical levels where S&P usually trades. So it's definitely at a much higher level historically. But you have to put this in context because we are in an unprecedented times, and the kind of monetary and fiscal stimulus programs that are running, that is something that will keep happening and keep running going forward as well. So if those stimulus programs, whether it is monetary or stimulus or the fiscal stimulus programs, I believe they will continue under the Biden administration and more broadly across the world as well. Given that now Democrats have control both on the House and the Senate, in fact, it will be even easier for them to push through some of their policy agenda points forward, meaning that the stimulus programs will continue, and also meaning that broadly the equity markets will remain supported because of that. Now, that is just one aspect of why I think, the equity markets, while at elevated levels, will continue to be supported. The other aspect that will really lead to, the equity markets going higher is the earnings growth that you're seeing. So the EPS, which is the earnings per share for the equity market, say S&P 500, is rebounded or expected to rebound sharply from 136 to 175. And what that means is that earnings rebound. So when you look at something from a valuation standpoint and you look at the PE ratio, the price is on the numerator, and sort of the earnings is in the denominator. What we are observing right now is an expansion both on the denominator as well as on the numerator, to the extent that there is a huge earnings rebound, and that coupled with elevated levels of the prices remaining because of the stimulus programs done by the government, means that the equity markets can continue their run up. While there might be bouts of volatility and there are uncertainties that are beyond our control, and those might result in some corrections in the near term. But I think if you look at the predictions on the street, the highest sort of prediction or the target price for S&P is 4,400 from JPM, going to the minimum, which is 3,800, and all of these are above the level at which S&P is trading right now. So generally a more bullish trend that you're seeing across the board, with a few of them saying that the growth can be as much as 10 to 15% even from these levels. So again, my view is that yes, while the valuations do look stretched, don't forget that there is a lot of support for the equity markets. There is the interest rates and all are going to be low for a foreseeable future. So when you're really looking for risk premium, there are very few places where you will really get the value from your sort of money. And cash right now lying in the bank is sort of a crime, right? Like you're getting almost nothing there. So only place where you can invest your money and expect to get decent returns ends up being in the equity markets. And alongside that, if there is a genuine recovery that we are seeing in terms of earnings and the vaccine rollouts and the broader economy opening up, I think all of those, if you look at it from that context, you can potentially see the high valuations sort of sustained, and going forward, you can see this 10 to 15% growth by the end of 2021. Right? Does that answer the question, Hayden, or anything in particular that was that I need to highlight even more?
Right, I think that answers the question in terms of whether it's a bubble and where this kind of surge is coming from. We have another next few questions regarding emerging markets, but that's upcoming in the next few slides. So maybe we can come back to that a bit later.
Absolutely, yeah. So I think that's again a question that we have heard quite a bit from our investors, and I think broadly we are in agreement in terms of what's been happening, not just in the US market but broadly across the world. Now, this is more of a trend analysis, but before even getting into these charts, I think it is important to highlight that while from a valuation standpoint, if you look at the US market, it is pretty high valuations with PE ratios, close to 20 to 25. The valuations on a relative basis does look much more attractive when you look at the Asian economies. And that, coupled with the fact that the Asian economies have generally been able to sort of go through the virus and the COVID pandemic in a much better manner. Going forward, if you look at from an expansionary standpoint and where all the growth is going to happen, I'm fairly bullish in terms of how the emerging markets in Asia, and more particularly regions within Asia, which is like China and other countries, could be places where you can look to diversify your investments much more rather than just being concentrated in the US. But at the same time, I don't think you should completely move out of the US. US will remain a place where I think the most innovative companies exist, and most of the policy sort of programs and broadly how the world economy sort of moves will be driven to a certain extent still from the US. So I think in general, I will remain in the US, but I will still try to get some exposure into the EM and Asia markets as well. Number one, from a valuation standpoint, they look much more attractive. Number two, because of things that we talked about in terms of USD potentially depreciating, and that could be a good hedge for you in terms of having exposure to some of these EM and Asia market equities as well. And then the third thing that the chart basically depicts is more from a trend standpoint. If you again go back in history and if you look at the Asian markets or emerging markets and compare the returns of the emerging markets compared to the US, what you will observe is through the bulk of the last decade, the US has really dominated the results and the returns. And that is sort of depicted in the left-hand side chart. The AAXG is basically, I think the Asian equities ex-Japan, and SPY is basically, the S&P 500. And when you plot the returns of, the Asian markets against S&P 500, you will see that the Asian economies, the equities, have not fared that well compared to S&P 500. And that was, there for the whole of last decade. So if you were emerging markets heavy over the last decade, you would have significantly underperformed in your returns. And to the extent that, if you were at 1, you would be, close to 0.5. So, the difference is like double when you consider emerging markets versus the US market over the last decade. But if you look more closely, 2020 and 2021, there is some reversal that we are beginning to see. And this is basically, the point that we were trying to highlight earlier as well in terms of, relative valuation, in terms of, how the Asian economies are positioned, plus the fact that the US dollar is weakening. It's not a bad idea to start having some exposures into the emerging market, and hopefully, this trend reversal can continue. Now, I think plotting the same trend reversal a little bit more, concentrated view, with a little bit more concentrated view, is basically doing the same analysis, but instead of Asian equities, we replace it with China. And what you see is that trend reversal is even, higher over here. So if you look at the left-hand side chart, the red line is starting to go up versus in the right-hand side chart, the red line is, already, starting to move quite steeply up. So basically, it's sort of depicting that there is an element of trend reversal that we are also observing. So that, coupled with all the other points that we mentioned, it's not a bad idea to have and build some exposure to the EM markets. Alongside that, I think also, this is again some research that we have done in terms of factor rotation that we are observing. Now, typically, if you go and do some research, there are typically 2 factors that really dominate the returns of the equity market. And these, returns again, or the factors had been, researched and proven to generate long-term returns based on, Nobel Prize winning, research and everything that was done. And the factors include value and small cap, right? So value is supposed to outperform growth over a long duration. But again, similar to what you saw with US versus emerging markets, the value sectors have, or value factor has significantly underperformed growth over the last decade. And similarly, the small caps have underperformed large caps over the last decade. Now, going forward, what we, when we did this analysis, again, concentrate on the right-hand side of both the charts. So the left-hand side chart is basically the value chart. versus the right-hand side chart is basically, the small cap versus large cap stock. What we observe is while on the small cap side, we do see a trend reversal happening, we don't see a big reversal happening yet into the value versus growth. So we're still a little bit more, tilted towards growth in terms of how we see the market. But in terms of where there are some, rotations that we are observing, it's really on the small caps where you see the small caps sort of trying to come back. And that is also sort of consistent with more cyclical sectors starting to make a comeback as the economies sort of recover, right? So I guess again, this is something very relevant in given that we have certain portfolios that do follow, factor-based investing. So if you have more questions later, we can address, in terms of how our portfolios are positioned to sort of cater to these factors as well. Any questions on that, Hidden, or is that clear enough?
I think as we were talking about the reversal for EM and Asia markets, now in our Syfe portfolios, of course, we have a component in emerging markets in China especially. So with this reversal, some users are actually curious about whether we'll be increasing this exposure in due time. So maybe we could address that as well.
Yeah, I think that's a great question. And again, this all of this research is ongoing at our end, and we are constantly looking at ways to improve our portfolios. So yeah, definitely hold your horses. We are looking at this data on a very, very close basis, and we will be taking action in terms of making sure that portfolios are generically positioned in a way to extract long-term returns for our clients. So yeah, I mean, these are important considerations, and in the near term, there will be these will be considered much more seriously and will be incorporated into our strategies as well.
All right, thank you, Ritesh. I think the next few questions, the information will unravel as we go through the next few slides. So maybe we can come back to those questions after.
Sure. I think so. Again, I think this is another very interesting slide and something that I wanted to talk about. Given the very, very low interest rate environment right now, I think it's a crime to hold too much cash in the bank. And at the same time, you don't get much. If you look at the different investment options that are available, the normal bonds that you typically subscribe to, the yields are so low, it hardly makes sense to invest into them. So if you look at on the chart at the right, on the left, the bottom sort of line basically depicts the aggregate bonds. So these are more investment grade and average sort of credit rating kind of bonds, and the returns are sub 2%, which really is not attractive at all, given that inflation is still close to 1.5–2%. People are looking at ways to find yield without taking excessive risk. And I think to that extent, if you look at the different options available, if you concentrate on the fixed income world, people are again looking at the EM markets. Again, from a relative value standpoint, the emerging market, the credit spreads are still much more wider compared to the similar credit for the US markets. So there is definitely room for improvement and room for growth for EM corporates and EM high yield as well. So that's an area where people and investors can look to generate much higher yield if they are income heavy or yield sort of hunting at this point of time. And more close home, I think it is important to also not forget that we have a very active Reits market. And in a Syfe context, we have a REIT specific portfolio as well. And again, given the low interest rate environment, REITs could be a very good strategy for us to invest into. And I think that, coupled with again the fact that US dollar weakening can continue, I think some allocation to REITs could be a very good way to hedge against that, plus generate more like an income-based strategy. On top of that, if inflation were to rise, REITs as an asset class is supposed to provide you some sort of an inflation hedge. So I think all of those factors combined, I think REITs could be a good place for investors to park some of their cash. And even though from an overall return standpoint, if you look at the REITs market for 2020, it had a great fall and then it recovered, but not fully, to the extent that now it is basically stuck in a range between 1300 to 1400 levels for this particular index that we track. But generally over the last few months, there has been an upward trend since the phase 3 reopening in Singapore and more vaccination related good news coming in. So my personal view is that this trend can continue. And there is a possibility that the REITs market can, sort of break this resistance level that we are seeing at around 1400 odd levels, right? So again, I think people and investors hunting for yield, places to look for that would be emerging market corporates, high yield, and REITs more closer home. Now, I guess, other than this, I think it's also very interesting to see that there are a lot of mega trends that are emerging right now. And for these mega trends to sort of play up, a lot of us now are at a point where we cannot simply ignore these mega trends. Now, in terms of what are these mega trends, I think the first thing to highlight would be, some of these innovation ETFs. I think a lot of investors have gotten to know about some of these ETFs, which are called ARK, A-R-K, and these ETFs have done phenomenally well over the last, couple of years. And these ETFs focus on, disruptive technology, innovation, next generation internet, and genomics. And again, some of these trends are not just a fad. These are, trends which are at inflection point, which means that we simply cannot ignore them any longer. If you look at the genomic ETF, for example, 2020, it trounced every other ETF in terms of returns. It was up 178%, just insane, the kind of, uptrend that was seen for this particular ETF for 2020. And again, that goes back to that point that I was mentioning, that there are, certain technologies and certain trends that are at an inflection point to the extent that they might become the dominant things going into the future. So while, these could be very, very volatile, these could be things that could be very risky, I think at a certain level, we cannot, we are not in a state to ignore them anymore. So while we should have all of our, sort of diversified portfolios, we should also look at some of these emerging trends and not be, remaining at the sidelines, but have a way to sort of participate into them. And, there are plenty of ways now with ETFs to get some of these exposures built in as well. Similarly, I think like cryptocurrencies, I don't have a view in terms of how the future unfolds for the cryptocurrencies, but it is very important to, again, highlight the point that, cryptocurrencies have been very, very volatile. And till now as well, the acceptance of cryptocurrencies was itself in question. But going forward, I think there has been more and more acceptance of the cryptocurrencies and Bitcoin and related technologies per se, to the extent that governments and a lot of influential people are starting to promote it. And that has led to a huge rally, and most of it, I think, is speculative in nature. But I think going forward, again, what we need to sort of have in mind is we are still at a very nascent stage of some of these technologies. And it is important for us to, sort of have these things in mind while we are building our long-term portfolios. And again, if you think about, the fiat currencies that exist in the current environment, including the US dollar and others, where you can just keep printing as much money as possible and, nothing's going to happen. I think, some of these currencies which are more controlled and they have limited supply could act as, a hedge against, the depreciation and the, the value degradation that you're observing for these fiat currencies per se. And I mean, who knows? I mean, I'm still, not sure whether Bitcoin or some of these things can actually act as a, replacement for gold and an inflation hedge. But certainly, I think the interest has shot up quite massively coming into 2021. And what that means is, again, this is a space that, we will be watching more closely too. Another very important trend, I think this is something that, a lot of us talk about and we want to say that we want to participate. But I think till now, there has been a lot of, empty talk and a lot of, things that, yes, I mean, everyone wants to be sustainable and, wants to invest in a more responsible manner. But I think there is, again, a point that is coming in now where there is much more serious things happening on the ground as well. And what, if you can observe this on two fronts in terms of, on the left-hand side, it is really in terms of actual investments that are going into sustainability and, sort of green technologies front. So green bonds, sustainable bonds, social bonds, and in general, the overall, growth that you're observing in this in terms of, money that has been raised, that is really shot up. And On the other side, from an investor standpoint, there is also more and more flows that are coming in into sustainable investments, and that is sort of depicted in terms of ETFs and mutual funds that have sustainable asset base, and those asset base have risen to the extent that now it is, I think, close to $1 trillion. Yeah, so 2021, close to $1 trillion, 1.3 if I remember correctly, and the trajectory looks like it is going to continue that way as well. So I guess now I think coming into the new generation of investors, plus in general the whole world is operating in a new normal. There is a genuine focus that is coming in. And on top of that, if you think about the Biden administration coming in and they potentially having a more clean energy kind of focus, what you can sort of think about is that is a genuine catalyst that will sort of impact all of these kind of investments and the sort of assets tracking those investments in terms of flows from money managers as well as investors like us. And what that means is going forward, these kind of asset classes can continue to outperform the more traditional ways of investing. And this is, again, something that we should not be ignoring anymore, right? So I think from a mega trend standpoint, these are three important things that I thought would be very interesting for investors to take note of. And going into 2021, 2022, these would be very interesting things to follow and maybe take some action as well. Great. So I'll pause here a bit, and Hayden, I'm sure some of these topics are of great interest to certain investors. So happy to take some questions on this.
Right. So currently, as we are looking at a lot of more working from home culture, I think some of our viewers today are also interested in our REITs portfolio. So in terms of with this pandemic still, we're seeing the shadows of this pandemic. How would the REITs market actually become? What can we actually expect?
Right. So I think as I covered earlier, right now, when you're looking at different asset classes and you are hunting for yield, there are really very few places where you can park your money and can sort of expect decent returns. That coupled with the fact that we are operating in a very low interest environment, and that is going to continue. Plus the US dollar and more sort of developed market currencies might depreciate. You would want to have some local Singapore dollar denominated investments, which becomes like a natural hedge against those depreciations or degradation in value per se. Plus, even if you think that with so much stimulus happening across the world and even in Singapore, if the inflation were to shoot up, REITs as an asset class provide you a little bit of a hedge against rising inflation, because real estate is supposed to be an inflation hedge as well. So those things, I think, coupled with the fact that right now, if you look at Singapore as a market, we are in a much, much better state than a lot of other countries. Like the virus is super contained over here. There are hardly any cases. We've already moved into phase 3. If you look at vaccinations, those are being rolled out. I think we will be one of the first few countries where most of the population will get vaccinated at a very fast pace, to the extent that if herd immunity is reached much earlier, we'll be able to open ourselves up even more further. I think all of those are huge catalysts for the REITs market. Now, coming into the REITs market and the REIT subsectors itself, if you look at the REIT subsector and specifically to our REIT portfolio, our REIT portfolio is a fairly diversified portfolio. We are investing not just into retail and office space REITs, which have sort of borne the brunt of the virus per se. We have REITs which also give you exposure to data center, industrial, healthcare, logistics. And these sectors have been in a sort of secular growth trend per se, and that will continue going forward. Plus the fact that if you look at those specific REITs that have borne the brunt, which is the office and the retail malls, right now with all these catalysts that I was talking about, these are more of the cyclical sectors, which I think will sort of recover faster, and they're more like catching up to the upward trend that was observed. So in my opinion, from a overall outlook standpoint, I'm fairly positive about REITs. If you look at from a 3 to 5 year horizon, I think REITs are a great investment. And overall, given that the yields and all are so low, REITs are still giving you 4.5% to 5% dividend yield, which is not bad, right? So I think I have fairly positive views on the REITs market.
Right, thank you, Ritesh. And I think one more question would be revolving around the equity 100, which we briefly touched on earlier. So
Mhm.
some of the factors that we're looking at, would the factors actually be rotated? Because earlier we did talk about, small caps seem to be coming up a little bit because now our equity 100 is more towards a large cap. So would there be a rotation in factors in time to come?
Right. So yeah, as I said earlier, we are actively researching in this aspect, and we don't just want to be a backward-looking strategy. These are important, sort of metrics to keep track of. And the equity 100 portfolio gets rebalanced every 6 months. So we don't want our portfolio at the same time to be too reactive to these changes and make these changes on a very short-term, trading oriented manner, but we look at these factors on a very, very long term basis. And when there is a genuine sort of reversal, that's when we would want to shift away and have more palatable sort of exposures to some of these other factors, which is maybe small cap or value. So again, we are working very hard to see how these factors behave going forward. And the next sort of rebalance is scheduled for April. So hopefully you will see some of those elements sort of incorporated when we do that rebalance in April. Even in October, for example, we did take some action, and it was again purely rules based, where the growth factor became almost 40 to 45% of our portfolio, and to the extent that it became too dominant in terms of its exposure, and we had trimmed that exposure back to 30%. Now again, as I said earlier, we don't think the value factor has really come to that extent that it is reversed the trend, and the growth related factors have sort of started to go down. We have not observed that yet, and what that means is we have not sort of taken off our exposure to the growth factor per se, but we might add some elements of, say, small cap and emerging markets as we look into the April rebalance.
All right. Thank you, Ritesh. Maybe we can take on one more question. I think this one is quite interesting, considering what has been going on with stocks like GameStop, AMC. How does this potentially kind of change the way we look at investments? And of course, for investors that are looking to invest in the longer term, because of these things that are happening, is this a good time to enter? Or generally, the time, we don't really time the market?
Yeah, so I think generally, again, factors that we always espouse the idea it is time in the market rather than timing the market. So, how do you know what is a good time to enter? Last week the market crashed, but within few days it came back. If you sold off your investments last week, you will be at a loss because by the time you want to come back, the market's already rallied. So I don't think we necessarily try to tell clients to try to sort of take advantage of these short-term short-term movements in the market. Rather, position your portfolio in a way such that you can weather through these short-term volatility in a much more stable manner, build your core to be really, really strong. And then if you really have some views, then incorporate them in terms of some of the things that we talked about when I talked about some of these mega trends, whether it is cryptocurrencies, whether it is genomics, healthcare, next generation internet, or any of these disruptive technologies. Maybe take some exposure to them, but don't make it a trading strategy, because if you make it a trading strategy, then you will constantly be trying to sort of get in and out, and more often than not, I think it ends up being a lot more speculative rather than thought through. So I think that same thing holds for GameStop and other things that we've been observing. It's really it's a phenomena which is called short squeeze, where the retail clients sort of flocked all together, and they knew that the stock was sort of shorted to the extent that it was even beyond the float. So it was shorted like 140% of the free float of the stock was shorted. So if a lot of people come in and start buying, it becomes very difficult for the people who have shorted to sort of remain in the trade, and that really led to that huge spike in terms of valuations that you're seeing. But from a fundamental standpoint, it doesn't make sense. At some point of time, it will die. Right now, I think of it more as a this multi-level marketing kind of a mechanism, because the first people who entered really made a lot of money, and now the newer people who are coming in, the older investors are just trying to keep them invested such that their money can keep growing. But at a certain point, it will all come crashing down again. So I think it is fun, but don't make it an investment strategy.
All right, thank you, Ritesh. I think the other questions, we can actually answer them a bit later then. Thank you.
Sure, absolutely. All right. So I think, given that context, I think it is very important that, we've talked a lot about different trends emerging, a hunt for yield and equity markets being at elevated levels. What that basically, tells us that, don't be too greedy, try to build a strong core portfolio first. What that means is build a more diversified portfolio, because over a longer term, that is what will give you much more steady performance. you know yes, small caps and growth related investments will obviously dominate returns in the long term, but not all of us are built to go through volatility in a very, very, mature manner. Or, I mean, not saying mature manner, but we are simply not geared. Like, we as individuals and we as investors are naturally loss averse in nature. When shit hits the fan, most of us will leave the market and will try to cash out as much as possible. And that is the problem when you invest into these high growth and high growth sectors and high return sectors and high return sort of areas. Over a longer duration, yes, you will make more money, but it's only because you're taking more risk. So there is no free lunch, right? You are getting more return because you are taking more risk. So if you really want to get a more steady return profile, you really need to build a diversified portfolio. And if you look at it from a return standpoint, you don't really sacrifice a lot of return when you have a diversified portfolio, but you significantly reduce your risk. So if you look at this on the right, the diversified portfolio annualized gives you around a 7% return, but the standard deviation of the portfolio is half of what you will observe if you're just investing into a small cap oriented stock. So again, very important to highlight that while it is great when the markets are on a bull run, the test really happens when the markets crash, and that's what happened in 2020, where a lot of investors lost money because they simply came out of the markets because they suffered huge losses, and by the time they could re-enter, the markets were already back up, and they missed out the whole rally, meaning that they made their paper losses actual realized losses. So again, I think another way to look at a diversified portfolio is it helps you protect your downside. So if you have a diversified portfolio, say, which has 60% stocks, 40% bonds, or 40% stocks, 60% stocks, you see that the kind of drawdowns that you observe for those portfolios is much, much lower compared to a portfolio which is just a pure equity market tracking portfolio. And because you have lower drawdowns, you remain invested, and over time, the recovery happens on all fronts. And maybe over the longer duration, a pure equity portfolio might outperform, but it's really, again, the fact that, will you be able to live through this, turmoil to see those good returns, right? So that's where I think a lot of us falter. So again, the point that I'm trying to highlight is make sure you have a core diversified portfolio to begin with. And then on top of that, you can have your satellites or your, more aggressive portfolios where you can really participate. This is, I think, just going back to the point that I mentioned earlier as well, that it is really time in the market, it's not timing the market that will make you money. And this is depicted by showing that if you were to take your money out for the 40 best days of the market, your return difference is so significant, where your, $10,000, if you began with that amount, if you missed the 40 best days, you will actually be down to 8,000 something dollars, versus if you remained fully invested through the ups and downs of the market and followed a consistent strategy, you will be at a much, much better place, right? So in summary, I think it is very important to just summarize all the things that we talked about today. I think, again, the good news is we have lived through the crisis. We are in a recovery mode. The vaccine rollout is happening. It will boost growth. There are concerns around the new COVID variants, which could delay the timeline for herd immunity. But overall, things look much, much more positive going into 2021 compared to what it was 2020. US equities remain supportive. I think overall the policy tailwinds will continue. And what that means is broadly the US equities will remain supported. Interest rates are also fairly low, and there is no indication of whether from a monetary standpoint, fiscal standpoint, or interest rate standpoint, anything is going to change in the near term. So while there might be bouts of volatility that you might expect, but broadly, the US markets should remain supported. Having said that, look out for factor rotation. I think some of these things we talked about earlier. So, small cap stocks, cyclicals, some of these are things that are looking to reverse trend and looking to catch up. And these could be interesting things for you to look out to as well. In terms of having a more diversified portfolio, hedging some of the currency risks that we talked about, and just from a relative value standpoint as well, emerging markets and Asian equities do look attractive, and they do offer long-term value. In terms of looking for yield, if you are looking for yield right now, the interest rates are really low. There are very few places where you can get decent yield without taking excessive risk. I think in general, the consensus is to remain sort of in more emerging market and high yield bonds, where again the valuations look much more compelling compared to similar sort of credits if you look in the US. And more closer to home, I think I'm a fairly having a fairly bullish or positive view on the Reits market in Singapore. Alongside that, I think, as I said earlier, don't ignore the mega trends anymore. If possible, do take some action, but these could be very, very volatile. So, I don't think these should become huge components of your portfolio, but I think they could definitely fit in somewhere as part of your overall exposure. And again, the point to highlight is build first a diversified portfolio, protect your downside, remain invested. If you follow these three principles first, then all of these other things can fit in very well into your investment framework. And long term, I think you will do really, really well in terms of capturing long-term growth in the market. All right, so now I guess before going into the introduction to Syfe, any other things we needed to cover, Hayden, or shall I just move on to the introductory part?
Right, I think we have covered most of them. We can actually move on to the introduction there.
Got it. Just give me a moment, yeah. Sorry about that. All right. So let's quickly go over now to sort of cover what we do at Syfe and how you can sort of implement some of these strategies that we talked about using Syfe portfolios. I think again, we are not gonna spend a lot of time in terms of sort of giving you background and stuff like that. I would want to just dive deep into our portfolio offerings right away. And I think the important thing to highlight from a Syfe standpoint is we are a very purpose-driven investment platform. We are a very goal-based and objectives-based investment platform. What that means is typically when you have money, you would want to do a few things with it. You either want to save it and generate some interest on it, like you want to hold it in cash, you want to keep it safe, but you want as high interest as possible. So that's your savings bucket. The second bucket is you want to cater to some of your long-term growth needs, right? So you have some long-term goals, like say retirement planning, financial independence, children's education, buying a house. These are all different goals that you might have. And for all of these goals, if you just keep the money in cash, it will be very difficult for you to realize those goals. You really need to invest it so that at least you beat inflation, and long term, you get closer to your goals per se. So equity 100 and global portfolios really are growth-oriented portfolios. And depending on what your investment horizon is, what your risk tolerance is, what your overall goal is, you can either choose one of them or you can even choose a combination of them. And then I think the third bucket is more of the income bucket. I actually categorize REITs as both income and growth because, alongside the fact that REITs give close to 4.5–5% dividend yield, REITs also grow in value because they're listed on the stock exchange and their value appreciates over time. You can use REITs as both the income strategy as well as a growth strategy. So what I've observed is more of our younger investors use REITs as a way to grow their money in local Singapore dollar terms. Because when you look at the Singapore market, there are hardly many investment avenues. The Singapore equity market hasn't given that great returns. It's a very stable, low growth kind of market. So if you're looking at growth, you really need to look at the global markets, and that's why our growth portfolios are catering more to the global equity markets per se rather than the Singapore market. And more locally, then from a local growth standpoint, we usually encourage investors to look at our REITs portfolio, because if you reinvest the dividend as a young investor, the dividend and the capital appreciation can still give you a decent amount of growth in local Singapore dollar terms, right? And more of our older investors then tend to, have a higher corpus and higher, asset size. So they tend to put a lump sum amount into the REITs portfolio and then generate like, a certain amount of passive income. So if you're, for example, looking for say $1,000 a month kind of a passive income, if you have say $200,000-$300,000 at 5% say dividend yield on a long-term basis, you're getting $12,000 to $15,000 a year, which is close to $1,000 a month. So that's how a lot of our more older investors look at the REITs portfolio while keeping their principal intact, because like you're just drawing out your dividends while the portfolio remains steady per se. Right. So now I think like, quickly just highlighting a little bit more on the mechanics of these portfolios. The cash plus portfolio, for example, right now the interest rates in the Singapore, market has come down quite massively to the extent that like, most of the banks have cut interest rates. Our cash plus portfolio is yielding 1.75%. And the reason it is able to do that is because it is investing into money market bonds coupled with certain short duration bond funds. And when you combine these two things together, you basically get a much better return profile without excessively taking risk. So in terms of risk level, this is like our lowest risk portfolio and gives you decent returns, given the other sort of avenues that you have in terms of holding cash. So 1.75% from that perspective looks fairly attractive. There is no lock-in, there is no limits, there is no tiers. We don't charge any management fee for this portfolio as well. We give you access to institutional class, funds that basically, you are investing into. And what that means is if you were to go directly, you will be charged a much, much higher fee. So, going via Syfe, you're getting a much better, return profile just by virtue of subscribing to institutional share classes. And also all the rebates that we receive from our fund managers, we pass it back to you as a client. So I think it's a fairly attractive offering from, the standpoint of giving you pretty good returns. And, also with the fact that there are no gimmicks attached to it per se, right? REITs portfolio, as I said earlier, it is like giving 4.5% to 5% dividend yield. On top of that, there is 2 to 3% growth that you can expect more on a long-term basis. So looking at close to 7-8% kind of annualized returns, more from a historical basis. That's what we have observed. The global ARI and equity 100 are the more growth-oriented portfolios. On the global ARI, the portfolio basically is a mix of equity, bond, and gold. So it's a little bit more of a balanced portfolio. So if you're planning to build a core portfolio which is fairly stable and doesn't have too much of drawdown through volatile times, that's where you can look at our global ARI portfolio. And within the global ARI portfolio, we have different risk levels. So depending on what risk level you choose, the proportion of equity, bond, and gold varies. So the lowest risk portfolio will have the lowest equity, the highest risk portfolio will have the highest equity. And again, depending on your investment time horizon, risk appetite and all, you can choose a particular risk level and accordingly then invest across asset classes, across geographies, and across sectors per se. Equity 100 on the other side is more like a way for you to, sort of capture more of the upside and sort of participate in the stock market directly without sort of worrying about the fact that it is a high growth portfolio, but it's also a little bit high risk, given that it's a pure equity portfolio. There is no bond or gold in it. And what that means is, you will bear the full sort of brunt of the markets in terms of upsides and downsides. But a lot of clients love this portfolio simply because of the fact that they contribute to it on a regular basis and it helps them dollar cost average. And again, like, something that people had asked us before in terms of, capturing some of the factors that I talked about earlier, the equity 100 portfolio uses a smart beta strategy. What it means is that we have, built it in a way to cater to all these factors that actually dominate returns to equity markets. So when you invest directly into just an S&P 500 versus invest into an equity 100, you're getting a much better return profile at a much lower risk level per se. And you're actually capturing all of these factors that are driving returns to your portfolio. So whether it is growth, value, small cap, large cap, high volatility, low volatility, these things are sort of embedded within our equity 100 portfolio. And there are some very popular ETFs that are also a part of this, sort of equity 100 portfolio, which makes it like fairly popular, as I told you earlier as well. All right. So I think just a quick, recap on, how can you sort of implement a core satellite approach into Syfe portfolios. So as I had covered earlier as well, build a strong core portfolio, a portfolio that is fairly diversified. And then on top of that, you can add elements where you have a specific need or you have a specific view on. So on the Syfe platform right now, what you can do is you can build a core using the global portfolio because it contains, 3 different asset classes. And then you can have satellites in terms of if you want an income heavy portfolio, you go for the Reits portfolio. If you want a high growth portfolio, then you go for equity 100. If you want to track some of those mega trends that we talked about, there are more customized solutions that are available on our platform as well, but they are more like, sophisticated. So, we'll have to take it offline. But essentially, the idea is with the Syfe platform, you can implement a lot of the things that we already talked about, and in a much more sort of cleaner way, and in a way in which you don't have to bother on a day-to-day basis to, sort of track these individual trends and capture them per se. We do that, hard work for you, and then you just basically need to decide what are the things that you care about the most, what are your goals, what are your objectives, and then accordingly invest as well. There's also an example over here, which is a much more sort of detailed one. It talks about a sample portfolio of a client and the different goals that the client has in terms of retirement, children's education, buying a holiday home, generating a passive income strategy, or having a growth focused investment profile per se. So depending on what you are, what stage you are in your life, what you want to achieve, and what are your chief priorities, you can design your own portfolio like this as well. I guess I think, again, very important to highlight that, Syfe as a platform is super easy to use. You can literally onboard yourself within minutes. Our platform is available both on the web as well as on the app stores. So both on Google Play Store as well as Apple App Store. It is very easy to sort of create your account. There is a, get started button on our website. You click on it, you choose your portfolio, you go through a few questions in terms of analyzing your risk. It then comes back with a recommendation to you, and then you can basically get invested. Once you get invested, everything is transparently shown to you in terms of performance, in terms of returns, in terms of, composition, transactions, fees, all of those will be shown. In terms of fees itself, fairly straightforward. The more you invest, lower the fees. And what that means is if you invest less than 20,000, then the annual management fee is 0.65%. If you invest more than 20,000 to 100,000, then it is 0.5. And if it is more than 100,000, then it is 0.4%. And this basically is the combination, the sum total of all your investments from the global ARI, equity 100 and Reits portfolio. It doesn't include the money that you put in the cash portfolio because that portfolio is anyways free. There is no management fee on the cash portfolio per se. And very important thing again to highlight is this is an all-inclusive pricing. There is no other hidden charges. So all trading and transaction costs are borne by us. There is no entry charge. There is no exit charge. There is no switching fee. You can freely switch between different portfolios. You can take your money out any point in time. All the rebalancings are done free of cost. All dividends are reinvested free of cost to you as well. So all of those things are taken care of. The ETFs that we use to build your portfolios, those are also very, very low fees in general. So overall, I think, the value that you get out of these portfolios, making your life very simple and having a goal-based investment sort of mechanism, you are paying a fairly low fee and you're getting more like, very high quality investment sort of mechanism without having to pay, the private banking or, more aggressive sort of banking related fees that is usually associated with such offerings. I think this is sort of self-explanatory in terms of, how Syfe is, positioned in terms of how it compares with the DIY kind of investments in terms of, there is no minimums, there is no need for a brokerage account. It is relatively straightforward. Risk management is, automatically available. I think I covered some of these points earlier as well. The dividends are automatically reinvested. The rebalances are done free of cost. There is no brokerage fee, and the management fee is sort of an all-inclusive thing, right? On top of that, we are not just a digital platform. We have actual human advisors who can interact with you, who can talk to you. You can share what you are thinking about, and they can help you understand our portfolios much, much better and help you make better decisions as well. So me, alongside my team of advisors, including Hayden, are there at your disposal. On our website, there is a way to reach out to us. There is a page on advisory, and there is a way to sort of schedule a free call with us. So feel free to reach out to us and ask us as much questions as possible. It is, again, possible that I wouldn't have time to cover all the questions that you might have today. So do leave us feedback, and if you have follow-ups, either email us or schedule a call with us. I think this section is not yet filled, but there are some upcoming webinars. In fact, every week we have a webinar, so do look out for them, and we will continue to come up with more interesting topics to cover. And last but not the least, as part of today's webinar, if you have if you're interested in joining the Syfe platform, please fill up this feedback form, and at the end of the feedback form, you will get a promo code through which you can sort of get 6 months of your management fee waived off. So, I think this is a good one for you to have, where you can just, try out the platform without having to worry about paying management fee. And then if you like it, then you can basically continue forward as well. So I will leave this QR code here, and I'm not sure what's the time. It's 8:20 already. So maybe a couple more questions, Hayden, and then we wrap it up.
Right. So actually, we have answered most of the questions earlier. So all the questions have been actually answered already. So we don't have any outstanding at the moment.
Awesome. That's great. So thank you, everyone, for joining us tonight. Hope this session was informative. We will upload this webinar onto YouTube as well. So if some of you want to see some of the things that we covered later on as well, look out for the video. I think sometime by tomorrow, it should get uploaded. So look out for it. And again, all the best for 2021. I think we are in a much, much better stage right now. Things look much more optimistic, and hopefully, going forward, things will be much, much better for all of us. So all the best, and happy investing.
Bye-bye, everyone.